What the next crisis would look like, I could probably, might be a little bit helpful in stopping it, but there will be other crises. There's no way of knowing when you're in a situation like we were in the fall of 2008 or 9, when or precisely how it will end. You know the United States will come back. The factories don't disappear, the farmland doesn't disappear, the skills of the people don't disappear, but you had a system which was going to put them all in an idle position, or could do it, and there's no way of knowing how far it was going to go. What's left from the crisis is pretty much our memories. I mean, the tracks are still there, the train's still there, but we had a big interruption in 2008 and 9.
2025 is here, and let's face it, things don't look good. The problem is that right now, markets are soaring, valuations are sky high, and it seems like nothing can stop this bull run. And then there's this Buffett quote: "Be fearful when others are greedy, and greedy when others are fearful." That's precisely when Buffett's words become more than just a quote. They're a warning. So what happens next? Is a market crash inevitable? And if it is, how can you prepare yourself? In this video, I will show you the key indicators that always appear before a crash, Buffett's unique approach to navigating downturns, and most importantly, how to position yourself for success when others are panicking.
Even though history doesn't repeat itself, it rhymes. We've seen devastating crashes wipe out trillions of dollars in today's money, from the Great Depression, the dot-com crash, the financial crisis, and the COVID crash. The warning signs are always there in hindsight, but when will the next crash hit, and how bad will it be?
Here's the thing about the stock market. It's not a straight line. Warren Buffett knows this better than anyone. He's been through it all: booms, busts, bubbles, and crashes. In his philosophy, it's grounded in one timeless truth: the market always swings, but it's the long-term view that matters. Buffett sees market cycles as inevitable, a part of the natural order. The market, in essence, reflects human emotions at scale. Fear and greed drive the highs and lows, and this cycle repeats over and over. Take the dot-com bubble in 2000 or the financial crisis in 2008. Both followed the same pattern. First, there's excitement and overconfidence. Then, prices shoot up faster than they should. Eventually, reality sets in and the crash happens. But here's what sets Buffett apart: he doesn't panic. Instead, he prepares and positions himself for what's next. Preparation doesn't mean predicting the future. Even Buffett doesn't try to time the market. What he does is focus on being ready for the inevitable. One of the Buffett key strategies is his infamous cash reserve. Right now, Berkshire Hathaway is sitting on billions of cash. Over $300 billion. Why? Because, as Buffett himself has said, cash is a hedge against stupidity. This isn't about hoarding cash forever. By keeping cash on hand, he avoids being fully invested during overvalued markets. Instead, he waits for the right moment, when others are panicking, and then he deploys that cash into undervalued opportunities. This approach was evident during the great financial crisis of 2008. While others were scrambling to sell, Buffett invested in companies like Goldman Sachs, profiting massively when the market recovered. His strategy highlights a crucial point. Downturns are temporary, but the opportunities they create can be transformative. Buffett often reminds investors that market crashes are inevitable. When prices rise too fast, greed takes over, pushing valuations to unsustainable levels. Eventually, the pendulum swings back and fear sets in.
You want to be greedy when others are fearful, and you want to be fearful when others are greedy.
This cycle of greed and fear doesn't change because human nature doesn't change. Emotions like fear of missing out or FOMO drives these bubbles, while panic drives crashes. Buffett doesn't fight these emotions, he plans around them. He knows disciplined investors can find the best deals during a crash because most others are too emotional to act logically. For example, when Buffett saw overconfidence and soaring valuations before the financial crisis, he kept cash reserves ready. And when the crash hit, he bought undervalued stocks at prices others thought impossible. His willingness to act when others hesitate is what sets him apart. But what are the signs Buffett watches for before the crash? And are we seeing these signs again? Market crashes don't just come out of nowhere. They leave clues. And Warren Buffett, he knows exactly where to look. Over decades of investing, he's identified 3 major red flags that tend to appear before a market collapse. First up, it's about excessive valuations. Sectors where prices climb far beyond their intrinsic value. Remember the dot-com bubble in 2000, the housing market crash in 2008, or the hype surrounding NFTs and crypto today? The pattern is always the same. When assets skyrocket without strong fundamentals to back them, the risks multiply. Let's simplify this. During the dot-com era, companies with no profits, sometimes no products, were valued in billions. The Nasdaq fell 83% after peaking, wiping out trillions of dollars. Buffett wasn't chasing those internet stocks then, meant he's not chasing speculative sectors like AI or meme stocks today. But it's not just Buffett who sees this. Take valuation metrics like price-to-earnings ratios. When these hit record highs, as they did before the 2008 crisis, you know the market is on shaky ground. Today, we're seeing similar signs. Some companies are trading at multiples that assume years of flawless growth. That's a recipe for trouble. The second red flag? Debt and inflation. Buffett knows that when companies or consumers rely too heavily on borrowed money, the system becomes fragile. Look at the 2008 financial crisis. Subprime mortgages, essentially loans given to people who couldn't afford them, caused the entire financial system to buckle. But debt alone is not the only issue. High inflation is another warning sign. When inflation rises quickly, it reduces purchasing power, slows spending, and eats into business profits. That's why Buffett closely monitors debt-to-GDP ratios and Federal Reserve policies. He knows that when inflation and debt rise together, the rise of a market pullback grows exponentially. In today's market conditions, rising interest rates are increasing the cost of borrowing, while inflation pressures companies to maintain profit margins. It's a double-edged sword that can easily lead to market instability. This graph showcases a dynamic interplay between government debt as a percentage of GDP and annual changes over 22 years. The blue line shows the rising and falling trajectory of debt, peaking at 124.73% in 2020, reflecting pandemic-induced economic strain. Conversely, the green and red bars highlight annual changes, with sharp increases during economic crises like 2009, 2020, and notable declines in recovery years like 2021 and 2022. Positive bars indicate fiscal expansion, while red underscores debt reduction efforts. This visual juxtaposition shows a delicate balancing act between borrowing for growth and maintaining fiscal sustainability amidst evolving global challenges. Then there's the investor sentiment. Markets are driven by emotions, not just fundamentals. When investors start chasing overhyped trends, like meme stocks or speculative cryptocurrencies, it's a signal that greed is taking over. Remember the GameStop frenzy? Some people made quick profits, but others lost big when the bubble burst. This isn't new. Investor overconfidence has been part of every major crash in history. And let's not forget the role fear plays. The 2020 COVID crash wasn't just about the virus. It was driven by panic. Markets lost over 30% in weeks because investors acted on fear, selling even solid companies at a discount. Buffett, however, stayed calm, knowing that panic-driven declines often recover quickly. But how can you spot these signs today? It's about extremes. When optimism or fear reaches record levels, it's time to step back and evaluate. For example, when everyday people with no market experience are giving you stock tips, that's a classic sign of overconfidence. On the flip side, when headlines scream doom and gloom, it could signal a buying opportunity. Now, here's the important part. These are warning signs, not guarantees. Buffett doesn't believe in predicting market crashes, he believes in preparation. When valuations soar, debt piles up, and sentiment becomes irrational. It's time to plan. For individual investors, the key takeaway is to avoid getting swept up in the crowd. Don't let greed push you into overvalued sectors, and don't let fear force you to sell during downturns. Instead, stick to a strategy grounded in fundamentals. However, the market thrives on balance, and when that balance tips too far, the cracks start to show. Understanding the red flags Buffett watches can help you navigate these moments with confidence.
I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt that it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
So, here's the big question. Are we nearing a market crash right now? If you're following Warren Buffett's playbook, some indicators suggest caution, but it's not all doom and gloom. To understand where we stand today, we need to look at the forces driving the market and what they mean for the months ahead. First, let's look at the big picture in 2024. The stock market is rising high, but the cracks are starting to show. Inflation, for one, remains a persistent issue, with prices on everything from groceries to gas climbing higher than many households can comfortably afford. To combat this, the Federal Reserve has been on a rate hiking spree, trying to slow the economy and bring inflation under control. But higher interest rates don't just cool inflation. They also increase borrowing costs for businesses and consumers. Companies now find themselves spending more on loans, which leaves less room for expansion or profit growth. For consumers, the impact is clear. Mortgages, credit cards, and auto loans are more expensive, leading to reduced spending, which is a key driver of economic growth. This graph dynamically compares the yearly average real interest rate, which is the blue line, and inflation rate, the orange line, over the years. It paints a compelling narrative from the interplay between inflation and real interest rates in the economic policy and performance. From 2000 to 2010, a general downward trend in real estate rates is clear, showing accommodative monetary policies during recessions like the 2008 financial crisis. Inflation rates, though volatile, remained above real rates, indicating periods of negative real returns for savers. The period from 2010 to 2020 is marked by persistently low real rates, often dipping below zero. This reflects aggressive stimulus efforts, particularly during the COVID-19 pandemic in 2020, when both real rates and inflation hit historic lows. Post-2020, the graph shows a sharp inflation spike peaking at 8% in 2022, overshadowing the modest recovery in real rates. This highlights the Federal Reserve's challenge in taming inflation while normalizing interest rates. This brings us to Warren Buffett's approach in today's environment. While many investors are piling into trending sectors like AI, green energy, and speculative assets, Buffett's focus, as always, is on value, fundamentals, and patience. This is why Berkshire Hathaway continues to hold substantial cash reserves, a move that reflects his belief in being prepared rather than reacting impulsively. Buffett's strategy is rooted in the idea that markets often overshoot in both directions. Let's take today's AI boom as an example. Companies like Nvidia have posted record-breaking stock gains thanks to excitement over their role in artificial intelligence. But how much of that growth is supported by fundamentals? Buffett would argue that true value lies in sustainable earnings, strong cash flow, and a durable competitive advantage. When those metrics don't align with soaring stock prices, it's often a sign that speculation is driving the market. And speculation in Buffett's eyes rarely ends well. He said before that if you can't explain how an asset generates cash, it's not an investment, it's a gamble. This cautious perspective extends beyond AI. Speculative assets like meme stocks, cryptocurrencies, and NFTs have captivated the attention of many investors. These assets may generate hype, but without a clear path to revenue or profit, they remain risky bets that can quickly turn sour. So, should you be worried as an investor? Well, that depends on how you've positioned yourself. If your portfolio leans heavily on speculative sectors like high-growth tech, it's time to reassess. Rising interest rates and economic uncertainty put these investments at risk as borrowing costs rise and future profits are discounted. Diversifying with stable investments, such as dividend-paying stocks or bonds, can help you stabilize your portfolio during market volatility. Focus on the fundamentals. Are the companies you've invested in profitable? Do they manage debt well? Do they have a clear competitive edge? Align your portfolio with your long-term goals and risk tolerance. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. Staying calm, disciplined, and consistent will always outperform emotional reactionary decisions. Market crashes aren't disasters, they're opportunities. History shows that downturns create the best buying moments for those who are prepared. Buffett's advice to be fearful when others are greedy and greedy when others are fearful reminds you to avoid panic selling and instead look for value in uncertain times. So, don't waste energy predicting the next crash. Focus on preparation, not panic. Every past crash has created wealth for prepared investors. The same will be true for the next one. The economy is mainly troubled by debt and interest. Trump is saying Elon will fix that. But does Elon Musk's approach actually fix it? Click the video on the screen to find out.